Many banks with CRE concentrations are making this mistake right now, and they're suffering the consequences because of it. This mistake has caused the most recent regulatory exam to have gone bad and has led to regulatory actions ranging from MRAs, which stands for matters requiring attention, to, in the worst case scenario, public consent orders. What is that mistake? It's when a bank with a CRE concentration takes a let's wait and see approach towards critical risk management processes, especially stress testing and capital planning, which are at the forefront of the examiner's focus. Many community banks are new to the CRE concentration world and have never received an MRA. MRAs might be the least punitive form of action taken by regulators, but that's only in comparison to the other actions available to them on the menu. The consequences of receiving MRAs is often overlooked and underestimated by community banks who have never received one. In this video, I will unpack some of the pain points associated with receiving MRAs, and by the end, you'll come to your own conclusions regarding the cost-benefit trade-off of the wait-and-see approach toward your next exam. Pain point number 1, MRAs are a huge distraction to management and the board. MRAs create stress and anxiety. They typically come with a tight deadline and the threat of, if you fail to meet that deadline or don't meet the MRA sufficiently, more regulatory action coming down the pike towards your bank. MRAs divert attention away from more important and highly critical activities, including running the bank on a day-to-day basis. The lost return on investment is difficult to quantify, but most bankers will tell you they are grossly overworked and their precious time does equate to lost money. Pain point number 2, MRAs are very expensive. Costs of implementing solutions will be higher because you lost control of the process. For example, say your bank receives an MRA for inadequate stress testing and you have 90 days to rectify it. Well, now you will be spending the next 90 days having to find the right partner to help implement a solution. And in that process, you're not thinking about cost. You've now made yourself inflexible to cost. You're more focused on the timeline and whether or not you're able to meet the requirements outlined in the MRA. If you had undertaken this process before your exam, time would have been on your side and you would be more sensitive to cost and probably would have negotiated a better arrangement with the partner that you ultimately choose to help you. MRAs often lead banks to incur additional expenses, such as seeking the guidance of lawyers and consultants who are more than happy to have the meter running throughout this process. Pain point number 3, and perhaps this is the most painful of them all. MRAs erode your credibility with the regulators and can lead to management downgrades and composite CAMELS ratings downgrades. At the end of the day, this is all about credibility and trust in terms of your relationship with your examiners. And if your credibility and trust with them was a currency, you would be burning a lot of that currency by taking the wait-and-see approach towards your next exam. MRAs put management and the board on their back foot. You are no longer telling your story from a position of maximum strength. It will open up your bank to a range of outcomes, including the possibility of IMCRs, which stands for Individual Minimum Capital Requirements, which is another way of saying higher capital requirements, CAMELS downgrade, and frankly, you'll lose a lot of the benefit of the doubt in other parts of the examination that might have been in the gray area and could have swung in your direction. Here's another issue associated with that lost credibility and trust. Your efforts in addressing the MRAs will be treated as a defensive measure designed to satisfy the MRA as opposed to an offensive measure that could have really helped the bank. Let me give you an example. We'll go back to the example where you received an MRA for an inadequate stress testing. You then go out, you find the right stress testing partner, and you implement a best-in-class stress test to satisfy the MRA. That best-in-class stress test is actually revealing the health of your CRE loan portfolio. And it's very well underwritten. And the stress test results prove it. And as a result, the stress tests are indicating that your bank could actually handle an even higher level of concentration of commercial real estate relative to capital than you have today. If you had done this before the exam, the likelihood of the regulators embracing this idea would have been much stronger. But because you took the wait and see approach, it will be far more difficult to get immediate acceptance of these higher limits. This could really cost you because without those higher limits, you may have to walk away from loans you could have made, or you may make the loan and have to participate out a significant portion of it off your balance sheet and lose the interest income you could have kept. Pain point number 4, and this is a sneaky one that nobody talks about, but I'm going to talk about it and listen carefully. The MRAs you will receive if you take the wait and see approach will be more difficult, far more difficult to deal with than the MRAs you would have received if you were proactive. What am I saying and what do I mean by that? I'm going to tell you an unspoken of secret. And regulators will never admit this. In fact, they will deny it. But those of us who have lots of industry experience, have worked with many banks, and been through multiple cycles know this to be the case. And that secret is that sometimes your MRAs are predetermined before the exam even starts. Why? Because at some of the regulatory agencies, the higher-ups decide they need to send a message to banks that meet certain characteristics. And the current climate, if you are a bank with a CRE concentration, and especially if you've grown your CRE book by more than 50% over the past 36 months, and your last exam wasn't that tough, put it in writing. You will be receiving MRAs. The real question comes down to, what MRAs will you be receiving? Because not all MRAs are created equal. If you are proactive about risk management, stress testing, and capital planning, and you have everything in place before your exam, you'll still be getting MRAs, but the MRAs will be much easier to deal with. You won't be getting an MRA for inadequate stress testing, but maybe you'll get an MRA for not having an updated model validation as an example. When a client calls me and tells me that that's what happened to them, I'm celebrating because I know that exam actually went well given the circumstances. I actually also know that the regulators are signaling to the bank in code they're actually satisfied with the stress testing the bank is doing. And I also know that solving the problem of not having an updated model validation is a very easy problem to solve. That is a far different situation than receiving an MRA for inadequate stress testing, which basically is a regulator's way of saying your process stinks. Totally different situation, night and day difference. Look, if you are a community bank with a CRE concentration and you haven't been through the ringer before with the regulators, I know it's tempting to take the path of least resistance. And that path of least resistance is usually the let's wait and see how our next exam goes approach. And it's easy to take solace in that approach, especially if your last exam went well, or you're not a bank located in New York City with large exposure to office towers and rent-regulated multifamily approaching $100 billion in assets, or frankly, it's just cheaper and less time-consuming to be reactive towards your next exam. But hopefully this video will demonstrate to you that more often than not, the let's wait and see approach will cost you far more in the long run. I hope you enjoyed this video. Please subscribe to our YouTube channel, and we'll see you soon.